Why is your credit card balance a little higher than you'd like it to be? Why are two-thirds of Americans cutting back on restaurants, on clothes, and entertainment while Wall Street's celebrating? Something doesn't add up, and today I'm going to show you exactly what it is. The answer is deliberately withheld. My name is Mike Adams with Adams Financial Concepts, and in the next 20 minutes, I'm going to walk you through what I believe is the most important financial story of 2026. One that most advisors aren't talking about, and one that could determine whether the next decade builds your wealth or destroys it. We're going to cover the new Federal Reserve Chairman and what his appointment signals. We're going to look at three hidden forces making a consumer recession. We're going to talk about where we are in the longest investment cycle most of us will ever live through. And at the end, I'm going to tell you exactly what we're doing about it at Adams Financial Concepts and how you can get a complimentary conversation about your own portfolio. Stay with me, because what I'm about to show you is not a prediction. It's already happening. You're already living it. You just haven't had the full story. The Federal Reserve just got a new chairman. His name's Kevin Marsh. And if you understand what his appointment really means, not the press conference words, but the historical pattern, you'll understand a lot about what's coming. Marsh has pledged to lead what he calls a reformed-oriented Fed. He wants to ditch rigid economic models. He favors real-time data. He holds a flexible view on inflation targets, and he sees lower interest rates as a tool for economic growth. Now, does any of that sound familiar? It should, because we've seen this exact movie before, and we know how it ends. The year was 1970. Richard Nixon was in the White House. The Federal Reserve Chairman at the time was a man named William McChesney Martin, one of the great inflation fighters in Fed history. Martin had watched inflation beginning to build through the early and late 1960s. He raised interest rates. He held the line. The economy drifted toward a recession. Richard Nixon wanted someone different. He wanted someone whose focus was the business cycle, someone who prioritized economic growth, someone with a flexible view on inflation. So he appointed Arthur Burns. Burns lowered rates. The economy grew. The stock market liked it for a while. Then came the 1970s, a decade of what economists called stagflation. Inflation rising while the economy stagnates and drops down. Prices double. The stock market went nowhere for 13 years. Actually, it went down 20% back, down 30% back to 1,000, back down 40% back to 1,000, down 20% back to 1,000. Now, I'm not saying that history repeats itself exactly. Markets are different. The global economy is different. But John Templeton is one of the great investors who ever lived, said something that's guided my thinking for 30 years. Templeton said, a secular bull market is born on pessimism, grows on skepticism, matures on optimism, and dies on euphoria. Born on pessimism. What stage of the market do you think we're in right now? The answer to that question and what it means for your money is exactly what this episode is about. And we're just getting started. Here's what I want you to think about. The definition of a recession is straightforward. A broad decline in economic activity. Consumer spending falls, businesses pull back, unemployment rises. Now look at this. Two-thirds of American consumers are cutting back on overall spending right now. 61% are cutting back on dining out. 52% on clothing and shoes, 49% on entertainment, 47% on travel. By every traditional measure, that is a recession. So why doesn't the data show that? Why is the stock market at record highs? I'm going to show you 3 reasons, and when you see them, you'll never look at the market the same way again. Reason number 1. Prices in April of 2025, the Trump administration opposed. Let me go back again and say that again. I got confused. Please hold with me, stay with me. In April of 2025, the Trump administration imposed sweeping tariffs on nearly all imported goods. Those tariffs were added to the cost of everything you buy. The Federal Reserve has documented that precisely. That between 90 and 96% of those tariff costs were passed directly onto consumers, directly onto you, in the form of higher prices. And then the Supreme Court struck those tariffs down. So let me ask you something. Let me ask you, have you seen companies announcing refunds? Have you gone to the grocery store and seen grocery prices coming down because there's no longer tariffs? Have you checked clothing? Are clothing prices coming down? Of course not, because those companies that reprice their goods didn't give their money back. They're not giving their money back. They kept it. And in many cases, they kept raising prices on top of it. The result is consumers are buying fewer items, but they're paying more per item. The volume of what Americans purchase is falling, but corporate revenues are holding. The recession is happening, but it's invisible to the income statement. The April 2026 personal consumption expenditure report from the Bureau of Economic Analysis tells the story. The Federal Reserve's own preferred measure of inflation. The Fed's own numbers show that core producer consumer expenditures is running at 3.3%. The headline number is 3.8%. The Fed's target is 2%. Inflation isn't retreating, it's accelerating. That's what's going on. Reason number 2, let's go back to this. Reason number 2 is that right now, 937 data centers are planned or under construction across the United States. 937. The 14 largest publicly owned data center operators alone are projected to spend nearly $750 billion this year. That's up from $450 billion last year. That's an extraordinary amount of money pouring it directly into the economy. Construction workers, engineers, equipment manufacturers, utilities, all of that activity masked the consumer pullback that's in the headline GDP numbers. The economy looks fine. In the data centers, it is. On Main Street, it isn't. And thinking about what's happening in the Middle East, even more consumer spending will happen with alternative energy worldwide. Whether we do that in the US or not, it's almost certain, with oil prices being where they are and probably increasing, we're going to see more expenditures there. All of that goes to keep the economy very strong. Reason number 3 is artificial intelligence. It's a massive cost-cutting tool for corporate America. Companies are doing more with fewer people. And those savings, most of it goes to the bottom line. Expanding profit margins on top of expanded and elevated revenues, on top of reduced consumer volume. Do you see what's happening? The stock market keeps rising on earnings and says things are great. Consumers at the grocery store sees rising prices and says things are hard. Both are right. They're both right. And that contradiction, that gap is exactly what we have to prepare for. Let's go back to this. You've probably heard the story. Drop a frog into boiling water and it leaps out immediately. But place the same frog in cool water and slowly raise the temperature. It'll just sit there. It adjusts to each small increase until it's too late. And that's how stagflation works. Prices don't double overnight. They rise 3% this year, then 4% next year, and then 5% at the grocery store, at the gas station, at the doctor's office, at the car dealership. Each increase feels manageable. You adjust. You cut back a little here, delay a purchase there, but compounded over 10 years, everyday costs don't just rise, they double, they triple. In the 1970s, a decade of stagflation following Arthur Burns' flexible inflation policy turned $1 purchasing power into about 50 cents. Now, let me show you something I think about a great deal. Markets move in long, slow cycles, what we call secular bull and secular bear markets. The secular bull market of 1941 to 1966 lasted 25 years. It was followed by a secular bear market from 1966 to 1979 that lasted 13 years. 13 years in which the market went nowhere. It began 1966 at 1,000. It ended in 1979, actually in 1982 at 1,000, but in 1979, it was at 800. From 1,000 to 800 in those 13 years. Essentially, because inflation eroded every dollar of normal gain. The secular bull market from 1979 to 2000, 21 years, went from 800 to 11,000 in the Dow, one of the greatest wealth creation periods in American history. And it was followed by the secular bear market of 2000 to 2009, 11 years. No, that's 9 years. My math is a little off. 9 years. The dot-com crash, the financial crisis, a lost decade for most investors, when the Dow went from 11,000 in March of 2000 to 6,600 in the first quarter of 2009. But in 2009, a new secular bull market began. We established the frog and water stage stagflation pattern. Let me tell you where we are. We're now 17 years into that bull market. And based on the data I've shown you, the new Fed chair, the inflation numbers, the consumer pullback, I believe we are in what John Templeton called the euphoric stage. The euphoric stage is real. It can last years. In the late 1990s, from 97 to 2000, some of the most rewarding years the market has ever produced. Investors who participated made extraordinary returns. But the investors who were prepared for what followed, the secular bear that began in 2000, they're the ones who didn't lose at all. So here's the question you need to be asking yourself right now. Am I positioned to benefit from the euphoria that's still here? And am I also building defenses for what history tells us come next? Because secular bear markets don't announce themselves. They begin while most people still believe the party is going. The investors who thrive are the ones who thought about it before the music stopped. I want to be direct right now, because everything I talked about everything I've talked about today, the cycles, the inflation, the hidden recession, the euphoria, it only matters if you have someone managing your money who actually understands and acts on it. So let me show you something. I want you to think about what this number would mean for your retirement. This is a chart of the actual compliant composite of people at Adams Financial Concepts. Real client accounts, real returns. Since 2009, if you'd invested $500,000 at the beginning of that secular bull market, that $500,000 would have grown to $7.4 million today. And in fact, we're getting close to the end of the second quarter, and it appears that we're up another 20 to 30% since that time. The estimated growth for that 500,000 with the average financial advisor, just 1.2 million. That's not a small difference. That's 6 times the return. That 6.2 million more is the difference between a retirement of comfort and a retirement of compromise. So the market contradiction we open with, record highs versus consumer pain. Now the question becomes, who's managing your money through what comes next? How did we build that gap? Not by swinging for the fences every year, by understanding cycles, by positioning for both the upside and the downside, by seeing the economic patterns, the Burns parallel, the stagflation setup, the euphoric stage, and acting before they became obvious. Every advisor will tell you they have a strategy, but what I can show you is a track record built across a secular bull market cycle, through corrections, through crashes, through recoveries. The question is not whether you need to think about this. You do. The question is whether you're going to think about it now, while the window's open, or later when it may be closed. And I always have to say, past performance is no guarantee of future returns. But let me bring it all together. We have a new Federal Reserve Chairman signaling a return to the same growth-first, flexible inflation framework that set up the stagflation of the 1970s. The consumer is already pulling back, quietly, steadily, across every discretionary category. Inflation is running above the Fed's own target, and the stock market is in the euphoric stage of a secular bull market that history tells us is the final chapter. None of that means that the market falls tomorrow. Euphoria can last years. But the time to prepare is now. When it's not when it's obvious, not when it's on the front page. Here's what I want you to do. I want you to ask yourself one question. If the secular bear market begins in the next 2 to 3 years and lasts a decade, is your portfolio ready? Not to just survive it, but to potentially thrive through it. At Adams Financial Concepts, that's exactly what we're building for right now. Client-structured portfolios to capture the remaining upside in this euphoric market, while putting the defenses in place for what history says comes next. Cycle aware, inflation aware. Build on a track record you can see, even though past performance does not guarantee future performance. That track record now is 20 years long. I'd like to have a conversation with you, a complimentary introduction. No pressure, no obligation, just a chance to look at where your portfolio is today and whether it's positioned for both sides of what's coming. The link is in the description. Take 60 seconds to schedule, and that conversation can be worth more to your retirement than anything else you do this year. At the beginning of the episode, I ask you, why does the stock market look great while your grocery bill doesn't? Now you know. Prices that never come down. A construction boom masking a consumer pullback. margin expansion, hiding the recession that's on the income statement, a Fed that's moving toward the same posture that set up the 1970s, and a market in the euphoric final stage of a bull market. You have a full picture now. What you do is up to you. I'm Mike Adams with Adams Financial Concepts. Thanks for watching The Measured Investor. If this was of value to you, share it with someone whose retirement you care about. Subscribe so you don't miss the next episode. And I'll see you next time. Do schedule your complimentary introduction.
Hey, Mike, it's Chris Prouty. Everyone, welcome here today. I didn't get to welcome some of you earlier in the broadcast. Thanks so much for being here. Mike, that was a great presentation. I'm going to ask Mike if you could leave the slides up for me for just a moment. Pardon me. Looks like there was a chat configuration issue with this week's Zoom. I'm not able to post into the webinar chat today. Normally, I would be posting a link where people could get a hold of you. But if you are here today and you do want to get a hold of Mike, you can see the URL at the bottom of the screen right now, adamsfinancialconcepts.com. You've got two choices to get a hold of Mike. You can either visit that page and then go to the contact page, and you will be able to communicate with Mike directly that way. Or if you are so inclined, you could send an email to mike@adamsfinancialconcepts.com. No matter what, you've got the domain right down there at the bottom. And Mike, because of that chat configuration, I don't have any questions queued up. But the last time you presented something like this, I do remember some of the questions that were asked. And one of those questions was, what can someone expect when they do take you up on a introduction call? What happens during that call, Mike?
During that call, it's low key. I'm pretty low key. I go through some of what I've just gone through today. I go through what we're doing for our clients and why we expect our clients to survive this whole period of time. And I talk about what people have in their own portfolio and give them some idea of what they can expect with their own portfolio. I'll point out the strong points. I'll point out the weak points. I'll talk about what they can do on their own or with their own advisor. So the information I believe is really valuable, and whether they choose to do business with me or not, I think they come away with something of greater understanding of where we are today and where we will be in the next few years, and the things they may be able to do to not only survive, but to thrive through the whole thing.
Mike, as this period of euphoria, as we've talked about, is here and with us, aside from the obvious and some of the things you've already talked about, are there any more smaller details, indicators, or behaviors in the market that we could look for that give us indications as to where we are and how long it's going to last?
Never know how long it's going to last. These things can go for 6 months, they can go for a month, they can go for 2 or 3 years. Alan Greenspan identified irrational exuberance at the end of 1996, and the market continued for another 3.5 years. It wasn't until March of 2000 that the market began to fall apart. You don't know. It could have fallen apart before that. During that period of time, things happened that should have set the market off. Long-term capital exploded in 1998. Long-term capital was, two Nobel Prize winners, economists, who put together this with a trader, and they were making 15% per year in one day.
Wow.
In one day, they lost all equity and went to a negative equity position.
Wow.
And Greenspan called together the banks and said, you have to loan money to long-term capital to cover what they're doing, or it will collapse the financial system. You would think with something in one day that almost collapsed the financial system, that would have ended the stock market euphoria.
Mm-hmm.
No, didn't at all. That euphoria continued for another 18 months. Everybody forgot about what was happening with long-term capital. It was a problem solved. They moved forward with it. So you don't know. What is the triggering event that's really sends things down? You don't know. The
Like
idea, the idea is to participate as long as it's going and to be prepared for it when it is no longer.
I would imagine that with more than 4 decades of experience, you've seen your fair share of similar situations. What strikes you as the most similar?
You know, I could see that the market was coming down in the 90s. And to be honest, I was so prepared for the market coming down that I missed the euphoria part of the market.
Mm-hmm.
In 1999, when the Dow was up 44%, my clients were up just 4%. It looked pretty sad. In 2000, when the market was down 40%, my clients were up 38%. So success in handling the downturn of the market, but not during the euphoric stage. I won't make that mistake again.
Well, once again, Mike, for everybody that's here, I will remind you, if you want to get a hold of Mike directly, you can email him at mike@adamsfinancialconcepts.com. If you look at the bottom of your screen, you can see that that URL is just one long phrase, adamsfinancialconcepts.com. Pop a Mike at before that, and you can email him directly. I know he reads and responds to every single email. You could also go to that website and use the contact form on the contact page to schedule a time to talk with Mike. And if you are watching this live with us today, you can go to our YouTube channel, which is About Money Radio. Just go to YouTube and search for About Money Radio, and that's where you'll find rebroadcasts of all of the Thursday episodes. And we ask that if you do go to the YouTube channel and you find value in what we present, give us a subscribe. That helps us surface in front of even more people who can use this financial advice. Mike, I got a question for you. What do we want to say about next week, Mike?
I will be gone next week. No live presentation. I will be attending my granddaughter's graduation from UCLA in biophysics, of all things.
Wow.
Crazy time. Anyway, I will be there to see her graduation. And the following week, I will be back with a workshop on something that could be very interesting. I've given a lot of stories about people that start with $1 or $2 or $3 or $500,000 in scenic row. The following week, I'm going to talk about a student whose parents were clients, but she started with just $2,000. Just $2,000. That account now is worth 117 or 118,000. She took money out to make a down payment on a condo. So it's not just large accounts, it's smaller accounts.
Mm-hmm.
So everybody gets the same treatment. And there's reasons I do that. And I'll be talking about that in 2 weeks.
I'm looking forward to that one, Mike. I want to thank everybody for being here today. Hope you got a ton out of this. We'll look forward to seeing you back here live in 2 weeks. Keep an eye on your email as well as the socials for what we might have going on next Thursday at this time in Mike's absence. I think we're going to try to put something together for you, even though Mike will be traveling. So, Mike, with that, thanks for a great presentation today. And as always, you get the final word.
Have a very good week and enjoy my time off. Take care. Bye-bye.